Hi everyone, I'm Damien.
And I'm Jeremy.
Welcome to our Suburb Data podcast, where we cover everything from property investing to expert busting. If you're new here, we share our personal and professional experiences from over 20 years in the game. So you skip the mistakes we made and go straight to property investment success. Today, Jeremy, Q&A.
Yeah, more Q&A. I haven't seen all of these, but thanks very much for putting your questions through. Just bear in mind that we can't answer all of them, and some of them, if they require a lot of detail, we might need to ask you more questions. So we're only going to answer the ones that we can answer in this Q&A.
Yeah, I guess the smaller ones, and it's hard to give, I guess, specific, proper advice. Like we sort of look at it and go, okay, how would we maybe approach it? So we don't know your circumstances. It's all general in nature. And if you do have any questions, you can send it to podcast@suburbdata.com.au. We are looking at sort of growing potentially a consulting service if that's something people are interested in. But we will look at the messages and see how we can potentially help. But Jeremy, before we get started, I wanted to start off with a quote. Okay. Getting a tax deduction only gives you a discount on what you pay. It never makes you money. So I guess
That was Dom, wasn't it?
That's, yes, our accountant Dom. Thanks for that. I really like that quote. Very deep.
I like that one too.
Finance.
That's great.
It's interesting how many people I think believe you might talk to someone at a barbecue or a party and they go, I've got a positively geared cash flow property or negatively geared. And you're like, they don't even know what negatively geared means. So at the end of the day, you want to make sure that your property's growing in value. So there's no point like losing money or having a bit of surplus cash flow if your property's not growing. So I would always say, well, how much did you pay for the property? How much is it growing by? Is it beating the average? But
yeah, capital growth, it trumps pretty much everything in property investing.
All right. So thank you to DJZJ. So, hey guys, great video. What about, I think this is the oversupply video that you did, Jeremy, or we did. What about Treeby in Perth? Has heaps of new land and house packages and land being developed. Currently at 900K plus and has grown at least 40%. Does that mean it's a risk now, although not the last 3 years has grown significantly? So how is this an issue? I know it's a massive risk now to buy, but 3 years ago it would have been a great buy. It has high land development, however.
Yeah, well, as a general rule, I would steer clear of those greenfield estates. It depends on how, well, you would have experienced this, how frequently land is being released and how much more land there is to come. So if there's plenty of vacant land there, you buy there and it's going to be a continual source of supply, which is going to thwart capital growth. So as a general rule, I would avoid those sort of greenfield areas. The other issue is that if you buy a new property, you are going to have loads of depreciation. So you've got to wait until a property has washed out over time, all those years of depreciation. I wouldn't buy a property unless at least it was 20 years old, preferably 40. So that's two big issues you've got with those greenfield estates. You want to avoid them. And
the other point is that land to asset ratio is also going to be very low.
Good one,
on a brand new property. The developers get paid, the builders put their margins in. And the other thing with a lot of these new builds is they're rubbish. They get a lot of subcontractors in, the build quality is quite cheap. So that's another negative that a lot of people don't really discuss. They just want to sort of pass it through. And with these volume builders, they just want to get that property out the door, work on the next one and cash in on their profits. But normally what you'd look for here, if you are looking at an investment of this type, the better way of doing it is maybe you buy the block yourself and then you choose a builder to work in with. But a lot of these blocks are small and it's really dependent on the area. But the first step I would do is you look at the local government area, look at all the suburbs, and then you look at maybe the vacancy rate and stock on market at the whole area to see, is there a lot of stock available, one in the whole LGA, and are there outliers? And the typical outliers that you will see are the ones that there's getting land and house packages advertised. So they might advertise it on realestate.com.au, but that's counted as a stock on market. correct?
Mm.
So the other thing you need to figure out is how quickly is the supply coming onto the market? Is it getting absorbed? So if it's like maybe one land developer that's potentially releasing these blocks, and I'm not sure about this Treeby in Perth, but if it's only one developer, that might be a little bit easier to work out. If you're realising that maybe the dwelling count's only going up by 200 a year, like it's very slow, but there's thousands of people registered for these blocks. When you go into the development display homes, there's going to be that constant pressure. So yes, you will see that capital growth if the demand is there, but I would want to look around and go, okay, well, that's brand new in Treeby. How about these other suburbs where maybe I'm getting a lot more land, I'm getting it at a lower price point, and I can add value to it? That's what I would be targeting. So I would personally steer clear from it, especially because people are aware of this now. If you get in maybe in the early releases of these land developments, that's where you make your money. When you start going to the back end, it can be a lot more difficult. And before you sign these contracts, you can work out, okay, well, this land and house package is going to cost me $900,000 as an example. But then let's say they're selling now for 1.2 million. So there's already, based on today's market, you're most probably going to make money right away because there's that buffer, but there's always a risk that supply is going to continue to happen. But that's a way you can sort of work out quickly, is there profit in the deal right away? There's no point doing the land and house as an investment, but then you're seeing that everything that's getting released now or being sold off after it's been built is the same price. There's no margin of profit in there right away. Mm. But those deals are really hard to find, I find these days anyway. A lot more easier before, but let's bring up some data.
Oh, good idea.
What do you think? So we'll bring up some data on this one that I had a look at. So Jeremy, just for our listeners, typically what we do here is I ask you for a set of data, don't I?
Oh, this is what it was for. Okay.
So we look at data and then we look at the local government area. So if we have a look at, where was Treeby over here? Here we go. So I will try and, discuss this in the best amount of detail I can for people that can't see the visuals. But Treeby's got a dwelling count of about 2,500 houses. But the main thing, over the last 3 years, it's grown about 40%. And the typical value is around 870,000. And the block size is only 375. So that indicates to me that they're obviously land and house packages in those areas. And when we bring it up on Google Maps, let's zoom in a little bit here. So if we have a look at Treeby, we just got the Google Maps open. Looks like there's a fair bit of development going on there. Jeremy, what do you think?
If you just scroll down a little bit, you can see some streets there that Google has marked in. So that's where all the new development is, and more to come. And if you zoom out a bit and look to the north and northeast, there's a lot more vacant land there. So, this is an area that can be developed well into the future. A lot more supply is coming to this market.
So Google Maps is one way to obviously see if there is that availability of land close by, but you can also look at the data. So what I like to look at are things like stock on market's mostly the key one. And like if you are looking at investing in a specific area, let's say it is one of these land and house packages, or maybe it's a property that's already, has been sold off as a land and house package and you buy it a couple of years after, because then it's not new then, is it? It's actually established.
Well, a couple of years after,
True.
You probably want to let a few more years of depreciation wash out of those properties first.
But if you look at Treeby, it's got a stock on market of about 1.4%, so not super high. There's a couple there like Jendacott. It's got 2.5% stock on market. A couple of other areas, Hammond Park, 2.14. So there's a couple outliers there where the stock on market number is a little higher, but nothing crazy. None of these things like maybe 5, 6, 7%.
Yeah, that's really worrying. But yeah, I'd say the benchmarks are around about 1%. Ideally, you want less than that. And right now, early 2025, around Australia, stock on market percentage is less than 1% because there's a bit of undersupply. So these are mostly oversupplied markets, these ones that you've picked out.
And you've also got a risk of infill metrics. So you can see here, as a part of the analysis, you just don't go, okay, great, I'm just going to go to this suburb because of this specific metric or score, you need to look at the infill risk. So on a fair few of these, it was high, and you need to sort of look in a bit deeper. But the suburbs that flagged out to me initially was like, for example, North Lake, had medium block size of 730 square meters, or even South Lake, properties around the $700,000 mark for 700 square meters. So I would be, instead of looking at these new areas, I'd be looking at the suburbs surrounding where there's a lot more value for an investment personally.
Yeah, I'm guessing that these 700 square meters, you're paying a large amount of money for that block of land, whereas in the greenfield estates where it's, what was Treeby? 375 square meters. That's the medium block size. That means you've got a very low land asset ratio, so you can expect low capital growth.
And there were a couple other outliers there where there were acres, but that I think is a bit further out in this sort of local government area. But interesting to see across the board that I'm not sure about Coogee there in Perth, but all the others, like we know that Perth has had significant 3-year growth of around sort of total around 40%, 40 to 50%. So you're sort of coming in, are you willing to, like long term, you'll do okay if you just buy it, forget about it. I think what really lures a lot of investors to Perth is the yield. It's still very enticing for investors, I believe.
Yeah, I did some numbers on Perth over the last 4 years. I think it was 57%. So you would, it's a bit hard to tell when it's 3 years, but you would want to be looking at, well, have a look at that. What's that bottom one, second from the bottom? 95% growth over the last 3 years. So that's already, that's banj up. That's done a hell of a lot of growth. I would be concerned about that. But something like 27%, Hamilton Hill, even Coolbell up 36%. That has almost underperformed Perth as a whole. So I wouldn't worry too much about that past growth. Ordinarily, you'd be looking, if you're looking at double-digit growth over the last 3 years, you would assume, it's already had its run, but not compared to the Perth average.
Well, with data, you look at it at a high level, and then you got to dive in a bit deeper. That's what it's about. And the first thing that you mentioned, that Bunjub that you mentioned that had the 95%, that can be very misleading because there's only 380 houses there. So you could have a typical value that was, 3 years ago that was $1 million, but maybe there weren't many high volume of sales. So you need to look at the dwelling count in the specific suburb. So like that's an outlier to me. So I'd be like, oh, why is there 95% growth? What I want to see is the 53, the 40%, 44, because that's showing me a bit of consistency. Maybe the ones that have more dwellings in there, you can see the areas that have 2,000 houses, 3,000 houses, they're very consistent, 33% growth, 40% growth, 49. So you've got more data points to look at, where the high volume ones, the data is going to be all over the shop.
Low volume ones. Yeah, like those bottom two.
Correct.
That's very small. But you look at Hamilton Hill there, 4,500 houses. Sorry, Hamilton Hill just up to.
Yes.
And only 28% capital growth over the last 3 years. So that has underperformed Perth generally. So you wouldn't be too much worried about too much growth in the past. But Treeby, the subject, I think 40% capital growth already. You've got a very small land asset ratio with those tiny block sizes, and more room for supply into the future.
So thank you for that question. Hopefully you get a bit of value out of that answer, but we would really dive into the data because you have to think, where else is my money best allocated now? Not 3 years ago. All you can do is just go, okay, this is my situation. What's my next best move? And not look at the growth that's happened. It's about what's going to give me the highest probability of capital growth for that next asset that I'm about to acquire. So you really need to think about it. Next one is from Luca Apps 947. Great episode, guys. I'd love to hear about the metrics that people often rely on, which in your experience don't have much weight in increasing the probability of capital growth. So we're going off the cuff here a bit, Jeremy, not much prep for this one, but what's your take on this? 'Cause
Oh,
I know
yeah, there's plenty of these sorts of things. I mean, proximity to the CBD is one that's nonsense, and yet people still believe in that. They believe in blue chip suburbs and blue chip properties, but they don't have any long term benefit. Wage growth, again, that's not seen in the data to have any correlation. Another one I see every now and then, people misinterpret demographics, so they'll refer to the fact that in this market you've got a lot of large families, so 2 bedrooms are not desirable, 2-bedroom units, but really they're interpreting demand. They're interpreting supply as if it's demand, so they've got that round the wrong way. People can't move into a 2-bedroom unit if there are no 2-bedroom units that are supplied to that market. So demographics can be another misleading indicator. There's very little demographic data I see that has predictive capability for capital growth. So there's more to come later on in the year. We're going to cover a lot of those sort of misunderstood metrics and misinterpreted metrics, but there's a sample of a few of them.
I think it can be really difficult because it's like you can look, I guess, Australia-wide, and you look at data points. Like, we're not the only data providers. There's others out there, and it's like they're going to tell you that they're the best. Someone else is going to say, we know best, or a buyer's agent firm is going to say, let's buy in Adelaide, for example, and they're like, well, why did you buy there? Oh, because they just told me to do so. So it's like they'll pick metrics or statistics that suit them, because all they do is really auto-generate these reports, make it all fluffy, long-winded, and it's like, look, this is too much, just buy the property for me. But the only way you'll know is how that property actually performs. And as I always say, buy the property, get a valuation every 12 months, and are you beating the national average? That's what you should be doing as an investor. Set a calendar reminder on your phone once a year, reoccurring, get a valuation done. Talk to your broker and work out, are your assets performing or not based on the metrics that you've purchased these properties on?
Oh, another one just thought of there is population growth.
That's the big...
At the micro level. Macro level, like Australia or interstate, it does have some benefit, but certainly at the suburb level, it could be a stronger indicator of supply than of demand.
I agree with that, definitely. The population growth is a big one that I hear all the time.
Yeah.
Considering all, the next one, thank you for that question, Sand Deep. Considering all major cities, Brisbane, Adelaide, Perth, and Melbourne and Sydney were already ahead, have boomed. What do you guys think of Darwin? Does it have the potential to grow in the near future? When I speak with local agents, the properties are getting snapped up within days, especially by interstate buyers agents. So we're not actively, Darwin hasn't popped up too much, but I think you were mentioning to me the other day about a couple suburbs popping up in the data.
Yeah, there are green shoots, light at the end of the tunnel for Darwin investors if they've already owned. I personally wouldn't be going in there just yet, but there are some promising suburbs in Darwin, and it's only a matter of time, as is always the case here with these cycles. Every suburb, every city eventually has its excellent capital growth periods, and so Darwin might not be too far off. I think there is potential there, but the last comment there, the properties are getting snapped up within days, especially by interstate buyers. So you would need to speak to an enormous number of local agents across the entire city to get a sound, reliable, representative read on the nature of supply and demand in that market. So you can't really speak to just a couple of agents, and bear in mind that agents may be a little bit biased in what they'll tell you, especially if you are in a state. And we don't want to be in those markets where it is fewer investors buying, because then you'll see the vacancy rate go up, and that's something that you can monitor. Have a look at the vacancy rate and see, is it going up dramatically over the last 6 months? That could be because an investor purchases property from an owner-occupier, and then they put it on the market for rent. And so you'll see the vacancy rate climb up. And those are the sort of areas you probably want to be cautious of.
Yeah, I think because we did talk about this. And look, have you been to Darwin before?
No. Oh, yes, I have. It was, many years ago.
Small place, right? It's not massive. So I'm thinking you need to be wary, because if you've got these buyers agents buying in droves over there, you're right. What would you look for? You double check if the vacancy rate's going to most probably increase significantly, because you've got all these rental properties. Because if it's not owner occupiers pushing up the prices and it's just investors, and then you're putting all these rentals on the property, are they going to be rented out, or are they going to be on the market for a while? So you'd see, I guess, a rental growth decline. You'd see rent going down in value because of the amount of supply coming on, but then also vacancy rates would shoot up too. So that's research you can do before going into one of these markets. So that's what I would be thinking about if I went into a market like Darwin. But I'm with you, I wouldn't be going there.
Not just yet. No.
Alrighty. So next is another one from DJ ZJ.
Yeah.
Hi team, banger of an episode. Can you make a video on negatives of having an investment property, as in what isn't being told? All the YouTube channels, etc., all talk about how easy and how good it is to own an investment property, but don't actually pro-bud specific costings and details and buffers and tenant issues, insurances, etc. They just talk about gross yield, which isn't net yield after costs. So we covered this I think we touched on episode 36, and we talked about different points here. And it's a key point. A lot of these, I guess, YouTube channels, they're going to promote property investing, aren't they? They're going to say there's not going to be many negatives.
Yeah.
It's like, hey, look how many properties I've got. Reach financial freedom, because that's, at the end of the day, why are we investing in property?
Yeah, it's for financial freedom. Yeah.
It's for freedom.
But no, he's got a good point there that it's not all roses. There are problems. I mean, I've had some pretty stressful moments in my portfolio, in my time of investing. But yeah, what was that episode? It
was episode 36. Yeah, I think it was a shares versus property, but it was things like the big fixed costs, the interest rates, especially like now the interest rates, it's putting you in that negative cash flow. So you're purchasing a property and your cash flow, you need to find surplus every month to fund that property to grow in value. That's the main thing. You've got council rates, could be strata, potential land tax, property insurance, maintenance fees, loan fees, even your time in purchasing properties, selling a property, buyer's agents fees, variable costs could be, maintenance, repairs. So there's a lot there that you need to consider, and your net yield is going to be potentially quite low. It's going to be low, isn't it? I think on average, let's say call it 2% your net yield. That's not even taking into account your interest expense. That's just rent minus all your property expenses. That's typically net yield that you'd be after.
Yeah, so it's not all roses. It's not easy. It will drain your cash flow, but putting the effort in, it's like anything. You got to put the effort in to get the results. So there's no dream easy answer.
From my experience, I think having exposure to property within Australia, it just works. Like, because everyone, when they're starting out, shares is a bit too much. I don't understand it. My friends have property, parents have property, family members. They just want to believe that they know property, they understand it, and people need somewhere to live. And Australia's a great country to live in, so they just always bias towards property. So the way I think about it is you're always going to get pushed into that, and there's always going to be pressure on pricing.
Yeah, until Australia becomes a rubbish country to live in, there's going to be pressure on prices here.
So I think that's that's the way that I would look at it. But I think you just need that asset to grow in value, but there are costs associated with owning a property, as we know. Next, thanks for a great video. How can we use, this is from Forex Educational Official. Thanks for a great video. How can we use maps to get supply? Is there any way we can get an absolute number?
Okay, so I'm assuming this is supply of property in an area. Yeah, I don't think you can get an idea of the actual current supply from the maps, but what I think they might be referring to is potential for future supply. So, yeah, it is one of those sorts of things. You got to just have a look on Google Maps and just see, is this a fully built out area, or is there a lot of vacant land that can be built out? So you can have areas where there's swampland or ravines or very steep sort of hills where you can't develop on them, or there could be some waterways or natural reserves that are not to be developed. But you can look at those on Google Maps and get an idea of just how much potential there is for development into the future. But you won't be able to get a precise figure because you don't know whether a developer's going to get in there and chop it up into 500 square metre blocks or 300 square metre blocks. And you don't know how many developers are going to do that. And the absolute number, that's not something you'd be interested in. You really want to look at the percentage stock on market because, like we saw earlier, you can have suburbs that are very large, which might have 5,000 houses, or they could be quite small and have 500 houses. So if there's 10 properties for sale in a suburb where there's 5,000 houses, that's not a huge amount of stock on market compared to if there are 10 properties for sale in a suburb where there's only 500 houses. So it's the stock on market percentage that you're interested in there, and those figures are published.
Yeah, I think stock on market is the main one that you'd look at current supply, and future supply, as you mentioned earlier, you'd look at maps, but then you can get the information from ABS to get an understanding of what's coming through, but that can change quite rapidly. As we know, there's a building shortage, and it's supply is struggling to keep up with demand, especially with a lot of these new builds for houses. So that's the way you can sort of, I guess, look at it if you are looking at going into these areas. But if it's for investment purposes, I'd try and avoid them if I can. Like, why go there if you can go to another area that's already built out as an investment?
Right. Yeah.
Unless the numbers stack up. You're getting in early to a development, potentially, there's a restriction. It's not constant farmland. There is a bit of that owner-occupier appeal. They're different variables that people don't talk about.
Yeah, there's a lot more research required there, but it is possible to make money in those areas. But if you're a novice investor, just steer clear, buy in a built-up area.
So our last question is from Tim. Hi, Damien and Jeremy. I'm a mid-30s based in Brisbane, earning approximately $150,000 per year. I've built a portfolio of 3 properties, a $1.2 million principal place of residence purchased for $500,000, so seen some good capital growth. An investment property worth $550,000 purchased for $320,000. I recently acquired a second investment for $630,000, which is now valued $640,000. I'm currently exploring options for my next investment, but I'm facing a dilemma. Pursuing a third property may push my borrowing capacity, while my offset account offers a highly attractive return of 7%. What would Damien and Jeremy do in this instance? Maybe you can do a case study on your podcast based on this. Well, we are right now. What do you think, Jeremy?
This is really your cup of tea, isn't it? Looking at people's financial situation.
Okay, so there's a couple things here, and you'd be surprised. I think the first thing I would want to understand is, like, what type of structure do you have? So how are your loans set up? Is your owner-occupier on principal and interest? Are you going to be there a long time? Are you planning on moving? So that's one variable that I don't know. The other variable is, are all my investment loans interest only? So they're the first things I'd want to look at. And then the other side of it is, what is your current cash flows like? And this is something, and look, leave a comment in the comments section if this is something you'd like for us to touch on in future episodes. I guess one of my, I'd say skills, would you say, Jeremy, or something that I've always been interested in has been money management, trying to increase surplus. I think that's a big thing to understand where you are today and what you're sort of working towards. And for me, it's always been about financial freedom. I do this because I love it. Obviously we talk about having more time and freeing up time as the business grows, but I think it's like, what is your end goal, Tim? That's what I want to understand. But if you're currently maxed out, let's say after all your income, all your expenses, your rent, your loan repayments, let's say you're only left with $1,000. You've got your holiday budget factored in there. You might be buying a new car. There's a lot of variables there. And let's say you go to your broker and they go, you can borrow 600,000-700,000. You need to work out how's that next investment property going to impact your cash flows. So you might be going from a surplus of saving $1,000 a month to maybe going back to negative $1,000 a month. So your surplus is going to get impact, but that's okay if you've got a buffer of $100,000 or $150,000 in your bank account because you've got time you can buy. So having that liquidity is really important while you're accumulating. If you've got like $10,000 in the offset account or bank, are you really going to push yourself and put yourself under all this financial pressure if there's no backup in any way? So there are different variables, the way that you need to look at it. And then I'd also maybe look at maybe the existing portfolio. Have they sort of tapped out on capital growth? And would you maybe look to offload one, recycle it, and maybe pay down more of your mortgage, potentially pay that non-deductible debt down, and then move that, take the equity release and then buy another investment property and borrowing majority of it. So you can look at it at different ways because it's like, why hold on to a property if you're not going to have future capital growth? But it is a headache. You got to buy, you got to sell. So I do understand that property isn't liquid. But back to this, that's the way that I would look at it. Now, the 7%, I'm assuming that's on his current mortgage rate. You're right. You have cash sitting or you're building up all your money in your offset. Your net return is going to be 7% after tax, which is nice. With property, we're looking at a return on investment, I'd say yearly about 20%. So we're taking on risk to get that return. Or if you're in the state where you don't want any more pressure, I'll just collect that 7% and have access to my money whenever I want to. You might want to utilize that money, like I said, for a holiday. Or it could be maybe diversifying into a stock portfolio if the market goes down, or you might want a dollar cost average. So again, it's just really difficult without knowing the whole picture. But overall, that's the way that I would look at it. If I had borrowing capacity, look, I'd most probably go again, I'd say, but it just depends on, am I going to reduce my workload? Am I close to retirement? But if I know I've got a big window, then I'd most probably try and utilize the bank's money wherever I can.
Yeah, I think it's interesting that Tim mentions the 7% there. So he's probably considering taking it a bit easy. And certainly from my personal experience, I was far too aggressive in my accumulation phase, and it just gave me a lot more stress. So you've got a good portfolio there already. You've got plenty of equity. Unless you really have a bee in your bonnet, maybe that is the best approach. Just 7%, take life easy for a bit.
I'd say when the rates were around that 3% mark, let's call it 3 years ago, before the rate rises, you do the modelling and people would buy that last property with maybe these smaller lenders, and the rate was a little bit higher, but they gave you the borrowing capacity. So you were limited to that one lender. And now what's happened is the rates have sort of gone up, but you can't move away from that lender because serviceability is being crushed and they've just put their rates up. So let's say the interest-only rates are around 6% on an investment. They might be going to 8% now. So they've got you locked in and you can't move unless you can sort of pay down some of your debt. So that's just the one thing you need to be wary of. So in that circumstance, let's say you did buy that property and you're really stretching yourself and then all the rates went up, you'd have to sell, which is ideally what you don't want to do with property right away. You need at least a 3 to 5 year breathing window to let that asset grow. 1 year I think is a bit short, but I think if you're going in to that growth phase, you at least want that 2 to 3 years, get that growth and then decide, look, do I start moving my money? And as we saw in that Perth, Perth has grown 40 to 50%. You could, if you want to be active, sell down and then move into another market that's got some higher chance of capital growth for the next 3 to 4 years. So hopefully that helps, Tim.
Yeah, I think this one is a good example of it comes down to that specific investor's situation.
And look, I'd have to put it on a spreadsheet. I'm going off the cuff here a little bit just from the experience, but I'm very interested to see where he purchased those properties. I'm assuming that 550 was maybe potentially Perth if you purchased it at 320. The owner-occupier looks like it's in Brisbane. So, look, healthy portfolio, but I guess it's just how much more debt you want to and how much you want to push yourself. But I think your lifestyle, a lot of people don't talk about it. Your lifestyle needs to come into it. You don't want stress. You want the properties just to sit there and enjoy life a little bit.
Yeah, that's right. Good advice.
Alrighty. So, Jez, where can listeners go for more resources?
Well, you can subscribe and then you get notified whenever we publish something else like this, and let us know if this is of interest to you. There's also a share link if you think that some of this content could help someone else.
That's right. So subscribe, like, share to the world, everyone. Thanks for tuning in and see you in our next episode. Bye for now and take care.